$438 billion in 1 quarter. The mega deal winter is officially dead.
It is a localized warming event, Nate. GIP dropping $33 billion on AES is just infrastructure doing infrastructure things.
Oh, come on. 155% jump year over year? Bankers are finally off the golf course.
Barely. North American acquirers are trailing benchmarks by 5%. They are just overpaying.
Overpaying or just highly caffeinated because Keurig Dr Pepper just swallowed a coffee empire. The rundown.
$438 billion in 1 quarter. I had to double check the spreadsheet this morning because a 155% jump year over year honestly sounds like a typo.
The mega deal is officially off life support. GIP and EQT dropping $33.4 billion on AES Corp alone is doing a lot of the heavy lifting there.
Sure, but it's not just infrastructure. Look at Keurig Dr Pepper. They just secured 96.22% of JDE Peet's.
Which is such a banker number. 96.22. Just admit you bought the whole thing and you're going to squeeze out the minority holdouts by Friday.
They basically did. Rafael Oliveira is already tapped to run this new global coffee monolith. But honestly, Nate, the deal that actually made me raise an eyebrow today was HG taking OneStream private for $6.4 billion.
Classic private equity playbook? Take the financial software firm off the public markets before the earnings multiples compress any further.
See, I completely disagree. I read the financing footnotes. This isn't about multiple compression. It's the steady interest rates. The debt markets are finally open again, and HG is just front-running the corporate AI arms race before someone else buys them.
Okay, fair point. But speaking of unwinding past moves, did you see the Intel chatter?
The Island Fab joint venture?
Yes, they are quietly maneuvering to buy back the 49% equity interest they just sold off. It's a massive strategic pivot.
I call it a very expensive backtrack. You don't sell half your European manufacturing capacity just to buy it back unless the original math was completely broken.
Or unless the market changed. Give them a break, Maya. At least they aren't the North American dealmakers from Q1.
Oh, the regional performance divide.
It's brutal. European acquirers outperformed their market index by 6% post-deal. North American buyers actually trailed their benchmarks by 5.4%. We are just blindly overpaying for growth over here.
We always overpay for growth. Halliburton just snapped up Sekal AS for drilling automation, and Home Bank shares just absorbed $1.77 billion in assets buying Mountain Commerce. Everyone is shopping.
And the biopharma sector is the absolute worst offender right now. Merck, Eli Lilly, Biogen, bankers are basically checking between their couch cushions to find independent biotech targets at this point.
Which is exactly what we need to unpack next. The big one.
$438 billion in a single quarter. I'm just imagining the bonus pools in Midtown Manhattan right now.
You can practically smell the steak dinners from here.
It's a 5-year high, Maya. Mergers and acquisitions are officially back. We saw a 155% year-over-year surge in Q1, and it's all mega deals.
Back for the bankers, maybe. But if you actually look at the post-deal performance data, it's a completely split reality. European acquirers actually outperformed their market index by 6% in Q1. North American dealmakers? They trailed their benchmarks by 5.4%.
Okay, but you're missing the forest for the spreadsheets.
I love the spreadsheets. The spreadsheets tell the truth.
The truth is that financing conditions finally eased up, rates stabilized, and corporate boards realized they can't sit on their hands forever, especially with this AI arms race. You either buy the capabilities or you become irrelevant.
Oh, come on. Half these companies are just slapping AI into the press release to justify a massive premium. It's pure corporate theater. Look at the actual crown jewel of the quarter. It has absolutely nothing to do with generative tech. It's dirt, steel, and power.
Right. The $33.4 billion elephant in the room.
GP and EQT taking out AES Corp.
It's a phenomenal play. Infrastructure is the new tech. EQT and GIP teaming up is like the Avengers of private capital assembling to buy the power grid. They know the data centers running your precious AI need electricity, and AES has the generation capacity.
I'm not saying it's a bad strategic fit. I'm saying $33.4 billion is a very steep price for a regulated utility portfolio. Have you read the footnotes on AES's debt load? They're absorbing a massive liability.
When you're GIP, you can engineer your way out of that debt. You strip it down, optimize the renewable assets, and flip the non-core stuff. It's the classic infrastructure playbook.
We'll see. I just get nervous when everyone rushes the exact same side of the boat. It's just like the biopharma sector right now. Merck, Eli Lilly, Biogen, they all went on a multi-billion-dollar shopping spree in March.
It's an absolute feeding frenzy. I heard bankers are practically shaking the biotech trees to see what independent targets fall out.
Which means they're overpaying. Again, North American dealmakers trailing the index by 5.4%. The data doesn't lie.
Well, speaking of overpaying and feeding frenzies, we need to talk about caffeine. Keurig Dr Pepper just swallowed 96% of a global coffee empire.
And the minority shareholders at JDE Peet are about to get squeezed. Voices. So the analysts are out in full force trying to explain this 155% surge in Q1 deal value.
Everyone wants to claim they called the bottom.
Exactly. The consensus note making the rounds attributes the $438 billion quarter to three things: eased financing, steady rates, and an intense corporate arms race for AI.
I mean, they are not wrong. The AI panic is real. You look at the tech multiples right now, it is pure FOMO driving the bus. Board members are terrified of missing out.
I am going to push back hard on that.
Oh, come on. You think AI is not driving the volume?
I think AI is the shiny object you former bankers put on slide 2 of the pitch deck to justify the fees. Look at the actual performance data. Deal strategists are pointing out a massive regional divide. European acquirers outperformed their market index by 6% in Q1. North American dealmakers, they trailed their benchmarks by 5.4%.
Wait, trailing by over 5%? That is a brutal spread.
It is, and Europe is not leading the AI arms race. They are doing structural, boring consolidation. The real driver here is just steady interest rates. Debt is predictable again, so the mega deals are back.
Fair point. Predictable debt is the ultimate aphrodisiac for a sponsor. But you cannot ignore the strategic panic happening elsewhere. Look at the biopharma sector. It is an absolute feeding frenzy right now.
Oh, the March shopping spree.
Yes, Merck, Eli Lilly, Biogen, they're snapping up everything with a pulse. Bankers are literally scrambling to identify the last remaining independent biotech targets. It is musical chairs with billions of dollars.
And do not forget Intel. They are quietly maneuvering to buy back that 49% equity interest in their Ireland fab joint venture, unwinding a European partnership they basically just set up.
It is total corporate whiplash.
Speaking of whiplash, we need to talk about what happens to the remaining minority shareholders, now that Keurig Dr Pepper owns 96% of JDE Peet's.
A global coffee monopoly is exactly the kind of caffeine this market needs. Spill the tea. So wait, you're telling me Intel is trying to buy back the exact same 49% of the Ireland fab they just spun into a joint venture?
Quietly maneuvering to buy it back. Yes.
That's peak corporate whiplash. I used to see this all the time. Management builds a joint venture to hide capital expenditures, gets cold feet, and then pays a premium to reverse the whole thing 12 months later.
Okay, hold on. It's not just cold feet. They're unwinding their entire European manufacturing partnership strategy. Look at the broader Q1 deal surge. We're talking 155% jump year over year. A lot of that is companies realizing their outsourced supply chains are massive liabilities.
No, I'm calling BS on that. This isn't some grand supply chain epiphany. This is Intel realizing they gave away way too much upside. They're just trying to fix a bad deal before investors notice.
I disagree. The data shows a stark regional divide right now. European acquirers actually outperformed their index by 6% after deals this quarter. North American dealmakers, they trailed their benchmarks by 5.4%. Intel is looking at those exact numbers and realizing their European partners are extracting all the value.
Trailed by 5.4%. Ouch. Well, that explains why the healthcare bankers I talk to are absolutely losing their minds trying to find independent targets right now.
Oh, the biopharma feeding frenzy. March was just absurd.
Merck, Eli, Lilly, Biogen, they're basically walking through the biotech aisle with a shopping cart and a blank check. I heard one VP say they're literally running out of companies to pitch.
Well, when financing conditions ease up, people stop reading the footnotes and start throwing multi-billion-dollar offers at anything with an FDA Phase 2 trial.
Exactly. Just slap an AI label on a protein string and watch the valuation double.
Which brings us to the ultimate hype collision: traditional finance buying crypto.
Oh, please tell me you're looking at the Franklin Templeton filing. Tomorrow's radar. Tomorrow I'm watching Intel. Gossip says they're quietly maneuvering to buy back that 49% equity stake in their Ireland fab joint venture, unwinding the whole European partnership.
Wait, really? After all the PR spin about that initial structure, I'm going to need to see the termination fees on that one.
Classic corporate flip-flop. But the regulatory filings I actually want tomorrow are Franklin Templeton buying liquid strategies from that coin fund spinoff. Traditional finance is just eating crypto alive right now.
I completely disagree. TradFi isn't eating crypto, they're just buying the plumbing because they're terrified of being obsolete. It's a defensive panic buy, not an offensive strategy.
Hey, they're still writing the checks. A deal is a deal.
Speaking of checks, keep an eye on Keurig Dr Pepper tomorrow. They hit 96.2% ownership of JDE Peet's. Now we get to watch the forced squeeze out of the holdouts for the new future global coffee company.
Minority shareholder squeeze-outs. My absolute favorite spectator sport. Have a good night, Maya.
Read your footnotes, Nate.